So PIMCO's diversified income strategy is a one-stop shop for credit. Okay. It has a 20-year track record. It has a benchmark which it follows, which is a third investment grade, a third high yield, and a third emerging markets. So a more high yield benchmark which can provide equity-like returns with about 2/3 of the volatility of the equity market. So over the last 20 years, the annualized return has been just north of 6%, so comfortably outperforming cash and also outperforming gilts, and a comparable return actually to equities with about 2/3 of the volatility. So gilts, particularly low coupon gilts, have great advantages from a tax perspective. We all know that. However, they also come with significant amount of volatility. This diversified income strategy is really focused on being diversified and providing an income. Over the longer term, we've seen this has outperformed gilts by about 5% per year and outperformed cash by a similar amount as well during that period. So it provides a lot of diversification. It provides a good risk-adjusted return, or an attractive risk-adjusted return, and it is not clearly dependent on just one area of the market. So we do think credit spreads are tight. Credit spreads are in the bottom quartile, or the tightest quartile, for the last 20 years. However, yields are clearly above average, so they're in the 60th or 70th percentile when you look from that point of view. So that gives you an idea of the total return still above average when you look at fixed income as a whole. Then the reason why credit spreads are tight is frankly for a couple of reasons. First of all, you have the situation where governments are spending more and they're increasing their levels of debt. So there's a certain amount of money which has moved into credit, which has actually delevered over the last few years, reduced its amount of debt in the higher rate environment. And then the second argument is actually a quality improvement. So we've seen through the growth in private credit and leverage loans, some of the riskiest names actually move into those markets, and the higher rate environment has actually led to lower leverage on the remaining names in the high yield bond market and in the investment grade bond market. As a result, the quality, or the credit quality, has actually improved. So above average yields, improved credit quality, and offering an attractive total return to investors, which has led to obviously spreads reducing versus, or tightening versus, government bonds. So it means that we can achieve high to mid single digit yields without actually stretching for too much risk. So the yield on the fund is around just over 6%, and the carry, which gives you a better idea of the next 12 months total return, is more like 7%. Now that's going without going into a high level of triple Cs or private credit or anywhere like that. So we can be defensively positioned without actually reaching for a high level of yield.